Today, we are facing a volatile real estate market. There's a question that's been buzzing around for some time now. Are we heading towards a repeat of the 2008 real estate crash? For those who may not recall, the 2008 crash was a significant event that sent shockwaves around the world, causing an economic downturn that took years to recover from. A time when property values plummeted, leaving many homeowners underwater and many more out of a home. Let's quickly rewind to 2008. Let's hear about the market then, from none other than the sage investor Warren Buffett. In the throes of the 2008 financial crisis, Buffett offered his unique perspective on the real estate market. He observed the domino effect that was in full swing as one sector after another crumbled. Inflated home prices, reckless lending practices, and over-optimistic predictions created the housing bubble that eventually burst. Buffett pointed out the ripple effect of the crash, extending far beyond the housing market. The financial institutions that had staked their fortunes on home prices found themselves on shaky ground. And now, fast forward to the present day, let's examine the current landscape of the real estate market. In the here and now, the real estate market is a complex tapestry of trends and statistics. To start with, the post-pandemic work-from-home model has resulted in many empty office buildings. This in turn negatively impacted the commercial real estate market. Now, to get a better idea of the residential housing market trends, let's talk about the analysis of the current situation by Fannie Mae. As of now, Fannie Mae, a major player in the U.S. housing finance system, forecasts a low level of housing activity in 2024. They attribute this to factors including rising interest rates and the end of pandemic-related forbearance programs. For a better perspective, let's take a look at the different key players in the housing market. To start with, many lenders today are offering flexible loan options and down payment assistance to home buyers. From the buyer's perspective, high interest rates and home prices are making houses less affordable. From the seller's standpoint, many homeowners are locked in low interest rates and are not in much hurry to sell. Interestingly, today's homeowners have a higher cash share of the home they own. This is a significant change from the year 2008. Many builders are offering incentives to boost home sales. These incentives include mortgage rate buy-downs, price cuts, and closing cost assistance. Adding to this puzzle, the home inventory remains low in many locations. In summary, the current real estate market is a mixed bag of trends. We're seeing a slowdown in price growth. However, a stronger labor market compared to year 2008 and buyer assistance programs are helping in maintaining demand. Now let us draw parallels between the past and the present. The current real estate market, while facing challenges, is not driven by the same reckless lending practices as in 2008. Lenders today are more cautious, extending their help to home buyers in a much more responsible manner. They have learned from the past and now emphasize the importance of a borrower's ability to repay, rather than just focusing on property value. But, could there be a domino effect today? Warren Buffett's reference to domino effect in 2008 was tied to a series of interconnected factors. These included interest rate hikes, inflation, and rising unemployment rates. Today we see some of these elements at play. Interest rates are on the rise, inflation is a concern, and while unemployment rates have improved, they are still a consideration. However, these factors alone may not be sufficient to trigger a domino effect similar to 2008. The financial system has been reformed significantly since then, with stricter regulations in place to prevent a repeat of such a disaster. All things considered, the real estate market today appears to be going through a soft landing rather than a crash. Prices are cooling off, but not plummeting. This is a stark contrast to the rapid decline seen in 2008 and suggests a more controlled, manageable adjustment. While there are similarities, there are also stark differences, particularly in how the market is responding. As we navigate through the current market, it's essential to keep in mind that history can indeed repeat itself, but it doesn't always do so in the same way. The lessons learned from 2008 have shaped today's market, and while challenges remain, they are being met with a greater degree of caution and foresight. So, what does this all mean for you, whether you're a buyer or a seller? Let's dive right in. First and foremost, it's important to remember that real estate market is cyclical. There are periods of expansion, followed by contraction and then stabilization. We're currently in a phase where housing prices are set for correction. If you're a buyer, this might be a bit of relief for you. A correction in housing prices could mean that the dream home you've been eyeing becomes more affordable. But remember, it's not just about price. Interest rates, inflation, and unemployment rates also play significant roles in the affordability of a home. Keep a close eye on these economic indicators. Additionally, buyers could make use of any flexible loan options or down payment assistance offered by lenders or builders. Now, if you're a seller, you might be thinking, is it the right time to sell? Well, it's not as black and white. If you're looking to upgrade or downgrade your home, you might still be able to make a good profit even with a slight correction in prices. Plus, if you're planning to buy another property after selling, you could benefit from lower prices on that end. However, it's crucial to keep in mind that each local market has its own dynamics, influenced by factors such as the local economy, job market, and population growth. Hence, it's advisable to consult with a local real estate professional who understands these dynamics. So, will history repeat itself, or are we heading towards a new chapter in real estate? As we've seen, the market today is quite different from the one we encountered in 2008. The current market analysis from Fannie Mae and the comparison between the two time periods all paint a picture of a market that's evolving. Corrections in real estate prices are being reported in media more frequently. In fact, there is consensus among many real estate experts that a market correction is long overdue, whether we like it or not. This is where the market slows down, prices correct themselves, but it hopefully won't lead to a full-blown crisis. It seems like a more healthier kind of adjustment than in year 2008. But remember, changes in interest rates, inflation, and unemployment rates directly affect the housing market. It's always important to stay informed and make decisions based on a broad understanding of the market. What do you think about the current real estate market? Did we miss any important points? We'd love to hear your thoughts. Thanks for watching. Please like, share, and subscribe if you found the video valuable. Until next time with another Investor Viewpoint, stay informed and stay safe.